Yes.
Oh, I think I've messed up the link. Hold on, let me send it one more time so that people can click it easy. There we go. So yeah, guys, Kenzo's our Friday regular. We really appreciate him coming on. I dropped his YouTube in the link, or in the YouTube link in the chat right there. Go subscribe to Kenzo. Thank you for coming on again, and we'll see you next week.
Thank you very much, man.
All right, have a good day. All right, guys, we are on to our last guest of the day. We got Chris Pulver coming on. He's going to go over all kinds of stuff with you. We love having Chris on. He's like the godfather of the markets. He knows everything. He's Neo plugged into the Matrix when he's got his tasty trade open. But he's coming on the show right now. I'm going to run one more quick break, and then we'll be right back with Chris Pulver. So give us just a second here. And right after this, we're going to hear from Chris. So don't go anywhere.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
Hey, everybody. Happy Friday. Thanks for that kind introduction, James. I appreciate that. I was wondering if you can spin that wheel in the back and tell me something to analyze. I just finished up a long session with my channel. Ran for about 80 minutes, and knew I was jumping on here with A1 Trading. So I'm happy to take requests and see what everyone wants to go through. I would imagine there's lots of golds, lots of dollars. But I was looking at this morning, some chop action. We've really seen little to no direction post CPI on Wednesday. This has been very, very choppy. Now, for today, I thought maybe on a Friday, the market wants to be a little bit more directional. Since we essentially had, this is Tuesday's close, this is Wednesday's open, CPI data got everything all exciting. And then Wednesday, we also had FOMC. This was how FOMC played out on Wednesday. When I was on the stream with Nick, we sat there and watched, and both of us tried to stay awake because nothing happened. And then Thursday, nothing happened. And then Friday, here we are. I do have an interesting thought. So I wanted to nerd out on something yesterday in my trading room, and I shared this in my live session. Tasty Live does incredible studies with 10-minute data on the SPY, on the SPX, on 0 DTE, on 45 days expiration. They're tried and true methodologies. I have some extra studies coming for me. I actually emailed Tom Sosnoff, and he was kind enough to send this on to the team. And actually, my request was, this was a 0 DTE study, which, for those of you who don't know what that is, that's 0 days to expiration, which has been popularized since 2022 when the major indexes and the ETFs are trading now with every single day you can have expirations. Now, if you go out far enough, you're going to see that those expirations go from weeklies and monthlies. But as you get closer and closer to real time, if I go out and I show you my Tasty platform right now, I can show you expirations on the SPY. So we have today's expiration. The 14th is a 0 DTE. And then you go out to Monday, that's 3 days out, then 4 days, then 6 days. So we skip a fifth day for whatever reason, but that'll get filled in next week. So we go 3, 4, 5, 6, 7, 10, 11, 12, 13, 14. This goes all the way out. And then after about 2 weeks, it skips a week and then skips a week, but it gets filled in as it goes. So all these option prices are now offered every single day. But you might be thinking like, oh, the 0 DT stuff is brand new. It's really not. I mean, today, for example, if you have an option trade that expires today, for example, I have an Adobe trade that expires next Friday. When we come to trading next Friday, that's considered a 0 DTE trade. So it's not really anything new. It's when the option contracts expire. But now it's something that's been more popularized. Why it's allowing kind of hedging every single day. It's allowing, you can maybe take some stabs at the futures market or these short-term option contracts to kind of hedge your portfolio a little bit, which is helpful, but it's also challenging because the sensitivity of these options, it's crazy that you have the full life cycle of an option plays out day to day. Like 0 days to expiration is your option contract either makes you money or it doesn't. And if you're a seller, you want it to finish out of the money. You want to suck out all that time premium, that decay. If you're a buyer, you obviously want direction. So anyway, I sent a request to the Tasty Live team, and like I said, Tom was kind enough to pass this on. This is Anton, this is Bob, and those aren't made up names. That's actually who they are. But I'm going to get some more information because talking about this for 90 minutes, this study was pretty incredible. It's a trade you can take every single day with a 94 to 91% win rate. And that might sound like, oh my gosh, that's incredible. But what I need to know, and I'll share this again when I get the information, I need to know not just the average win, but the average loss. I need to know the average loss, because if the average loss at a 91 or 94% win rate is small enough, I mean, we could still take a 2x loss or 3x loss and still make a lot of money in the strategy. But if that loss is 5x or 10x, it's a break even or losing strategy. So I just need a little bit more information, but we'll share that hopefully next week when I have it. All right, let's take a look at some requests. I see this right now. I saw Pound New Zealand from Jackie. Why do you think the DXY is strong? Look, I think that we have an interesting look. We have a tight dollar, number one. So I think the reason the dollar is strong is because the market's finally deciding to go somewhere. So, I mean, I don't want to sit there and get into the minutia of like fundamentals and the dollar. I mean, look, the dollar economy or the U.S. economy is doing okay, resilient, I would say, and decent. But CPI data, came in better than expected. That should ultimately, help the economy. A stronger dollar means a good sign for the economy as well. Also, right now, we're in a position where the Fed is likely the central bank that's going to cut the last. That's what it sounds like. ECB cut, Swiss National Bank cut, Bank of Canada cut. We have rate decisions next week, which you should pay attention to. The RBA cuts, or not cuts. The RBA has a rate decision next week. The Bank of England has a rate decision next week, and the Swiss National Bank have rate decisions next week. These are all important to watch. Now, as forecasted, this is supposed to be a pause from the RBA, meaning they don't do anything. They keep the rates steady at 4.35. It's forecasted for the Bank of England on Thursday. This is kind of a super Thursday next week. Bank of England, 5.25, expected to stay the same. So another pause there. Swiss National Bank, this is weird. I kind of hope they do. I hope they cut more. I hope they cut to 1.25. But the previous is 1.5. The forecast is 1.38. That's weird. I don't know. I've never seen a central bank go 0.12%. The BOJ went like 0.9 or 0.1%. We see a lot of quarter percent, so like 25 basis points. But we'll see. So we do have central banks that are starting to line up into the cut camp, and the Fed is likely the bank that's hanging on the longest. If you were with this session on Wednesday and you sat through 90 minutes or 2 hours really, from FOMC to closing bell, not much happened. And Powell did a fantastic job, as he always does, of just saying everything that the market can't really discern. He did say definitively that hikes are not the plan. He did say that. So hikes aren't the plan, but watching data, and inflation hasn't gone down low enough. So to answer your question, and I'll summarize this and I'll get some more comments. And Frank's in the room. What's up, dude?
Hey, how's it going, Chris?
I think it's good. We're gonna have some fun today. I think what I take away from the dollar here is the dollar has been tight trading for a month, and now the dollar is trying to go somewhere. Now, just because it's up today at 105.76, I want to make sure that today's daily candle closes above 105.60, and make sure that today's weekly candle closes above 105.60. Because if that is the case, next week I would then look for something along these lines. If the dollar index is going to stay here, so let's say that we have, that was a noisy couple of days between, we had last week, 3 days of bullishness. We had Wednesday all bearish, and then Thursday took some of that back, and then Friday, today obviously pushing higher. So to me, this is the support level on the dollar. If I traded small enough, I want to be a swing trader. If I bought dollar basket right now and I put my stop loss below that swing, that would be my trade, and I'd try to go after like 1.5 to 1 or better. Or obviously you try to go as big as you can profit wise. If you want to get a little bit tighter on those stop losses, then you're looking for something like this. We break, we retest, and then we go. And we kind of, this is an ugly little trend line break. But anyway, I just think that the first time in a month, the dollar has been coiled and now we're getting some directional movement. And that's why the dollar's just decided. The market decided the dollar should get stronger. So it's happening. I'm watching price and I'm not going to argue with that. So like I said, it's hard to jump into the details and say, what does this all mean? Why is the dollar? Two things. Central bank for the Fed, the Fed is probably the last central bank to cut. And the dollar's in a choppy range for a month and it decided to go somewhere. So that's where I'm at, and I'm following the technicals. Frank, sir, happy Friday, man. What's up?
Happy Friday. How are you liking that Adobe trade?
I'm loving the Adobe trade, but I want to see it. I want to close out today for profit. I would like to see Adobe. Number one, it was. Well, I wish that I don't know if I pressed it out. I don't think I did because it would have been like it would have been like a $3,000 risk, and I was like, I'm not feeling that. But that would have been a sweet little $2,000 to $3,000 profit had I forked over that money on that huge move, because that was a ridiculous, way beyond expectations for Adobe, especially at an IV rank of 4. Frank, that's crazy, dude. We just played the expected move. I did it with credit spreads. It didn't cost me a lot of money. And right now I'm showing here that the mid price is around $5. I have a limit to get out of this trade at $5, which gives me $2.35 net credit. I'm going to try to close that today. I still see the spread is quite wide, but it's tightened up a little bit since we've been live this morning to opening bell. I will watch this towards the end of the day. I've got all my trades in for my accounts. All my trades are in at $5. So if I close it out, I close out for plus $2.35 a contract, and I'll take that. And that would be 5 for 5 this week. I'm pretty confident Adobe is going to be a winner. It's just, do I close it today at $5, or do I have to wait till Monday to bust $5? So did you do anything on Adobe with me or no?
No, I mean, I kind of wanted to, but again, I can't right now.
Oh yeah, you were in some day trading stuff, yeah?
I had an early assignment actually. So
Oh, was that Lulu?
they assigned me, I think it was 100 short shares
Okay.
of Lulu.
Yep.
And so obviously I don't have the capital to like stay within the margin requirement.
Sure.
So it's kind of restricted my trading since, I mean, that was 3 days ago, since Wednesday. So
Yeah.
I've been out of the market, just can't make any moves or do anything. But yeah, I talked to them. They were like, probably on Monday you'll be able to trade again. But
Probably on Monday. Well, maybe.
it's kind of annoying to be like stuck in this when you see setups going on and then you have your own broker is telling you can't trade. It's a little frustrating, but I mean, it is what it is, and I guess I'll get back to it on Monday. But hopefully the market, as in like the indices, don't make any huge moves until then. I hope it stays in this low volatility zone.
Well, I mean, speaking of that, I mean, this overall, like, day to day has been a really interesting week, because it was, I mean, the story of like nothing happens. I'm gonna use a different color here. The story of nothing happens, right? We have 3 days of garbage, and then we have a gap higher, and then we have 3 days of garbage, right? So what's next? What's the next catalyst? Is there anything next week as far as U.S. news? We have a PMI data coming out on Friday. We have unemployment claims Thursday. We don't really have a lot of major news. Earnings wise, I'm pretty sure next week is nothing. I can check the calendar here. Oh, this is one thing I thought was interesting. The fear and greed index sitting here at fear. And I don't know. I didn't finish my thought on this earlier this morning, but I thought market momentum, extreme greed, that makes sense. I think that we've talked about this a lot this week, but extreme greed in the market, we've got to be a little cautious of a pullback, because when this is usually happening, yes, the market can drift higher. Yes, the market can melt up higher. But man, if we just get a little ounce of volatility or a little pop to the downside, or I should say a little slide to the downside, at least just normalize a little bit. But I was interested, like, how is this at a fear index with everything going on in the market? Because extreme greed in the market, then we go to stock price strength, extreme fear. Like, what the heck's that about? New 52-week highs and lows. I don't understand how it's extreme fear for stock price strength, extreme fear for stock price breadth. I'm really like perplexed on how this is. Like, you've got put and call options, extreme greed, market volatility is neutral, safe haven demand is fear, right? I mean, I don't know, man. I guess we got people like stoked at all-time highs and super fearful at the same time. So
Yeah, I don't think maybe something's wrong with that gauge because that doesn't really make any sense. I want to know if there's like historical numbers for this gauge. Like,
well, let's
when did it turn to fear?
well, let's do this. I think a better one would be, let me go to the AAII, which you guys have that in the Edge Finder.
Yeah. So
Let me go to the
that
sentiment survey.
actually,
What is that showing right now as far as bullish versus bearish? So right here, week ending 6/12, we're showing 44 bullish to 25 bearish. The extremes, so the bullish high is 52%, so it's not super extreme. Historical average is 37. So just taking this information, it's certainly, more tilted bullish, but not ridiculously extreme. I mean, 1-year highs at 53%. I am assuming that probably would have been in March, in all honesty. I bet March would have been where we got to these 1-year highs or close to it. Nope, it says December 2023. Well, that was pretty
so
good when the market was up for the full quarter.
what I got now on the Edge Finder is it
Walk me through it. Where are we at?
until Wednesday, which is when they do the survey,
Yep.
which was CPI and FOMC. We were
Mhm.
looking at a pretty broad decline, and then we saw lower
That's true.
CPI, and I think that's what boosted everyone's sentiment again. So it
That's a
looks
good
like
point. Yeah.
bullishness is there in the stock market. I don't really see fear, if I'm being honest. I see
Yeah,
a lack
that's
of
why.
volume, but
Yeah.
I don't
I,
think
I
people are bearish.
I don't think so either. Like, honestly, when I looked at this morning, the CNN Fear and Greed Index didn't make any sense to me. So I mean, I get it, that momentum at extreme greed. Like, yeah, we could see this, rolling over a little bit, but to see, stock price strength, fear, stock price breadth, fear, volatility or a safe haven demand, fear. It's like, what? I mean, I don't know. So I'm gonna say that let's lean more towards the AAII. Let's lean more towards the smart money. One thing, let's look at smart money actually.
I'm looking at the put call ratio too. So the options market is
Yep.
showing that we are actually pretty bullish too. There's a slight decline today towards neutrality, but Wednesday and yesterday we were at like 70%, which is pretty bullish.
Yeah.
Um, yeah, it doesn't look like we're fearful, which I guess is the scary thing.
Let me float something out here. Let's see if I can take this. There we go. So if I go out to 620, there are slightly more calls than puts on the SPY. You go out to June, there's more. I'm sorry, this is the 20th and 21st. And okay, so this is really interesting, man. And now this obviously can change like very quickly, but basically for next week, so the 20th and 21st, 20th, and I just think this is going to change coming into next week, so I'll take a look. But we have 26,000 favoring puts. We have 23,000 favoring calls going into next Friday. Actually, well, that's Thursday. Friday, we have 81 to 70 favoring calls. But you go out to July, it's way heavier on the put side right now out to July. Now, I don't know, how abruptly this changes, but I'm going to watch it. And so going back to the Edge Finder, let's dock this right here. The one thing I keep looking at as far as smart money, and this is interesting, right? Retail positioning is much lower than commitment of traders. So your CTAs, your funds, your institutions, your smart money, if you will, are still positioned pretty long, and price is going higher. Retailers are short. So
And
your average retail trader is short, and I
trend
think
now
that's
is lower. But like this week, we saw a pretty significant decline in just long positions for the S&P and the US 30
yeah
at least.
yeah
The tech stocks, they saw a pretty big increase of 2%, but um, I think retail is right, but they like calling that reversal. So I think that
they're early.
they're
I
early.
think they're early. I mean
So
that's why it's been melting up.
they're a precursor. I think they're a sign that we're going to see a lower market, but the second the S&P dips like 1%, that retail's going to flip back up to bullish, and then you're going to see the trend on COT get increasingly bearish over time, and
Yeah,
retail's going to keep trying to buy that dip and buy that dip. So I think they're for the first time in a while, I think that they are correct here. They're early.
maybe. Well, so early, but you have to remember too that retail traders typically have way smaller pockets, and so they can be early. But here's what's interesting: this market melts up more, that retail crowd gets beat up, and their options expire worthless. Their bearish positions are getting beat up, and all of a sudden they're getting squeezed out of their positions, and then I don't know. I mean, I it's always it's kind of a contrarian play, right? You use like retail money as a way to just play against it and stay contrarian to the herd, because usually their timings are pretty terrible. So if they're early, I don't disagree that there's some type of correction needed, but as we've seen, like from this rip in May, right? This is the daily chart. I mean, this rip that we had after April's correction, May rip. Um, I I mean, look, it's a trend line, dude. I mean, I think that right now, if we're gonna rip, this is the easiest way to see that the sellers are coming in. So right now, if this goes sideways, you gotta just give this market props to say, look, here's lows, there's a trend line support. If it breaks the trend line, we should sell it and try to grab some short-term trades, and maybe that gets a little bit more violent. I don't know. But until then, I don't know why we're so interested in calling the top, when in fact what we should be doing is just trailing profits and protecting our portfolio. If anything you're doing right now, it would be protecting your good positions and making sure that they don't give back a lot of profit. That's the best thing to do. And then what is down, I mean, I just had a chart alarm today that I was like, oh crap, I might lose on that trade. I had an expiration on Zoom, but it was May 31st. I mean, this thing has dropped from $64 down to $57. I'm out of the trade with 73 cents credit per contract, which is great, but I literally thought I had a trade open. And I was like, well, that sucks. So I'm going to take a break even on it now. But I ended up, it was already passed. But the alarm went off this morning. I mean, there are stocks out there that look like terrible. There are stocks out there that's like, it's beat up. It's at these crazy lows. The market, broad market's been going higher. So few stocks are going higher. And yet you can look at hundreds of stocks that are underperforming. Case in point would be your RSP, right? Your equal weighted S&P. Why is the RSP not made a high since March of this year? Pretty interesting, right? Like the market is not equally weighted. So the S&P is certainly market cap heavy and highly concentrated. And you just got to wonder, like, is the broader market going to be able to sustain this? I mean, I don't know if you, well, I'll just give the fact. This is the best start up to the June 14th point, like halfway through the year. This is the best start in history to the S&P 500 in an election year. The best start ever at 12 plus percent. That's pretty impressive. And this is like the top 20 all-time starts of the year with how many higher highs we made. So all-time highs, like top 20 of ever. So it's certainly in the ballpark of like a good percentile of a bullish market. But it's weird to see that it's not a supported broad market, right? Market breadth is not what you'd kind of want to see. So like the Dow has turned sour. The IWM can't get a break above 210. And yet the Qs have notched 3 higher highs this week. The SPY notched 1 to 2 higher highs this week. And it just keeps plugging away. So protect what's working well. But I think you gotta expect some type of downturn. And I don't know, what it's going to be, what the catalyst will be, when it's going to happen. It might just happen. And so I think we go back to the chart on the SPY, and if this trend line doesn't want to break, I mean, it's also summer trading and we're getting lower volume. So do you think this market just moves like crazy? Not necessarily, right? I mean,
No,
it's going
I
to be a
don't
summer
think there's
slowdown.
enough.
Yeah.
We're past earnings. We've
Yep.
passed the last 2 weeks of jobs and inflation, FOMC, interest rates. It's off the table now.
Yep.
We have, I guess, we have retail sales next week. PMI, flash PMI though. We don't have anything that will necessarily move it. I think I think if anything's going to happen, we're probably not going to see any major sell-offs. It could just be either a slow churn up or down in either direction. But I just think the market's kind of taking a break, if anything.
I think so too. Which and that's one thing I had mentioned this many times this week. It's like we haven't seen the market take a break. I mean, if you think about this, this market didn't take a break through this, August, September correction. This market didn't take a break with the October low to November rip, November, December, little pause for the holidays for like a week. And then January, February, March, didn't take a break in April with the correction, didn't take a break in May, hasn't really taken a break in July or June just because we had the big CPI gap. And so direction is still pushing, but we haven't seen, when you have trend and trend and trend and trend, what happened to this? What happened to just nothing? What happened to sideways? What happened to consolidation? I mean, if the dollar can do it for a month, the stock market can certainly do it. So you're probably onto something there. And I think that also means that you have to set some proper expectations. And I know for me, like I'm going into my portfolio here, like I'm going to be taking another close look, going through with the comb and trying to figure out like what else can I be doing with my positions. A lot of these are in red today. But it's because we just have aggressive shifts. A lot of these are option trades being sold. But Apple, I mean, this shows like I am down, but it's like I'm up $3,000 on Apple. I'm just having like an overall like portfolio pullback. But I mean, I started this portfolio at like 1.8. So it's doing okay. It's just I've got a red day. But I mean, position wise, I'm still watching. I mean, I look at all these positions like I have a case that I'm trading. I have a core position in all these that I'm interested in trading. And, I take the green and the red in stride. And I like some of the positions. I think that I might take some assignments on some Chinese stocks in the next maybe 30 to 45 days, which I'm okay with. But obviously I don't want to see, like Alibaba is like this big cash cow sleeping giant that just doesn't get any love in the market. And I don't know why. I mean, I thought once we finally cleared this hurdle on the right side of the trend line, this thing would be ready to rip. Lifting animal spirits and looking for kind of the global growth scenario hasn't really had any follow through. So I have a lot of interest in this stock, but I also might have to temper my expectations with might be choppier for longer. So same thing could be translating into our stock market, which is up and up and up and away. But at some point, even if we get the oversold or overbought conditions, even just a 1 to 2% pause that goes from high to low, and we have like a little 1 to 2% range, I think that would be enough to kind of just slow this thing down a little bit, let the market catch up, and then we get into another earnings season, and then we see if that's another kind of broader catalyst to see things go better. We get into obviously like August, September. I really think the market is waiting with bated breath on September. They after this week, let's actually check this. The Fed Watch tool, coolest, dumbest tool ever, because it changes every single day until it's the day of FOMC. Here's July expected to be a pause. September, it's. I mean, this was up to like 66 or 67 right after the FOMC, and now it's down to 61. I still think the probability is the market expects a cut in September, but maybe
I
one
don't
cut.
think that's. I just don't think that's the case. And so here's what I found from
when you
Yahoo.
say the case. Say, let me ask you this: when you say the case, you think that the market's not going to cut? You don't think the Fed's going to cut in September?
No. And
okay.
Here's
that's
the
the risk.
thing.
That's a risk-off event then. If that's the case and this thing flips Because look, this tool has never been wrong since 2009. Now they stick to
Well,
that
it's going
because
to
it
change.
changes so much. Of
It's going
course,
to
it
change
changes all the time.
drastically. So I
But
think
that change is where the sell-off occurs, right? Like when this is going to change and say, crap, there's no rate cut, something's going to get priced in. Like this market will react and have a tantrum and sell off when they believe like, oh fudge, now the rate cut's not going to be till December, or
right.
maybe not at all because it's an election year. Who knows?
Once it happens, yeah, that sell off will likely come. But I'm just looking at you. If you take forecasts, so
Mhm.
me and Nick like didn't buy this initially when they wanted. He said 3 rate cuts this year, and people expected the first one in March. This is
Yep.
old news,
Yep.
but this is comparing the forecasts going forward from March when they made
Okay.
this report to now. So
Okay.
now what we're seeing is a broader, a broader
Of no cuts.
consensus of
Yep.
maybe 1 cut this year.
Yep.
Um, and a slower decline in inflation over time or interest rates over time. So this change from 3 cuts to 1 cut, we're 6 months into the year. Who's to say that we get to October, November, or say we're at September and he's still saying the same thing, that we're not
He
confident yet.
he totally
And
will. He
and you're
totally will
looking
say
at
the same thing.
inflation from last year, this time to now, we're at the same spot.
Agreed.
Whereas in Europe, they've seen a big decline. There
Yep.
is stubborn inflation there. They might have been premature on their rate cut too, but they're at least seeing a trend. We are not seeing any trend in inflation. It's still in the same spot. It's gone up, it's gone down. We're at the same place we've been in. There's no
Mhm.
progress. So where would people get any confidence that we're going to see a cut unless we see some kind of trend down lower below 3 or what if we can eventually get to 2? That's the question is are we going to see that trend down or are we going to stay where we're at? And if we're going to stay where we're at, what is the rationale of cutting? And there isn't
It's
one.
true. Well, and again, not to be political here, but and obviously the Fed is not supposed to be political, but I do think an important feather in the Biden administration would be if the Fed cuts and this market can rip and melt up and capitulate, that might be enough of a economical highlight to maybe lean Biden administration as a staying incumbent versus. I mean, I get it. I
I
don't
mean,
want to
yeah,
think of
you're right,
Biden
but a
Trump.
cut will do more damage than good.
I
If
I
we were
don't
to
I
do
don't
this,
I don't disagree. I don't disagree, but I think the reality is I if this wasn't an election year, I don't think that the market gets anything. But because it's an election year, I almost think that the market is willing or wanting, and the Fed is willing to play a little bit of political inside baseball to be like, here's a test. Like he said this on Wednesday, by the way. Jerome Powell said this. If I were to look in the long term and it's all, was a 20, I'm paraphrasing obviously, but like a 25 basis points cut on whether it was good or bad. I mean, in the grand scheme, if we're ultimately trying to get rates down to 3%, a 25 basis points cut, whether it's September, December, or into 2025, really doesn't freaking matter. It really doesn't matter. But the market right now cares so much about it. But I don't see his narrative changing. That's what you're spot on. Like, I don't think he's going to change how he says what he says every single meeting or every single FOMC minutes that we read. It's going to be the same thing. And it's just going to be a matter of what happens to see, like, okay, so we'll have July prints and June CPI or inflation data. We'll have August prints to July's data. We'll have September prints to August data. So we'll have 3 more rounds of inflation data before the Fed has to make a decision on September 18th, right? And so this gauge will change. Whether it's up or down, we don't know. But I think right now the Fed has put the market in a way. I think the market is going to be able to kind of chill and go to sleep for the next maybe 60 days because the language hasn't changed. And
yeah.
unless we have like a big wild crazy earnings season, even that could we've been really really lucky, dude. I mean, honestly, how many trades have we taken in earnings season this year so far to the halfway point where they have blown through expectations?
Yeah, the
Like
majority of them
tons of them.
to
And
the point
so
where
I'm happy that we've traded options the way that we have. I mean, if I show um let me go to my equities. I think I tracked this and took the profit already. Oops, that's my tracking sheet. Yeah. So if I go to my tracker here, so I think I updated this already. If I didn't, I will. Okay, so Adobe. Yeah, so we're updated. So profit on Oracle, profit on Qs, profit on SPY. I just look back here. There's way more green than red, and a lot of these have been option earnings plays. Way more green than red. Like I have like 69% wins, 70% wins on a lot of these trades with even risk rewards. So, I mean, it's been pretty easy to carve out some pretty good profits here. Just trading the market's excitement, and earnings tends to get the market excited. You know, Adobe, for example, that is a blowout type move that they did mention AI, right? And it's like, it's so dumb, but it's also like, who cares? It's a nice way to make some money. And the trade is done. And it's, I mean, you take the trade on a Monday or Tuesday, and it's Friday, and you can take profit today. I mean, the SPY, the Qs, I took the trade Mondays, took the profit on Wednesday. It's like, that's awesome, dude. So anyway, my point is, it's been a good season, but it's like, I'm also prepared for like a crappy earnings season, that like the market doesn't get too excited and there's not enough volume to really push it around. But it's you never know, man. It's like low volume markets can also be the perfect window for like these blowout moves, because it gives the market something to latch onto. You know, exciting earnings season can get these markets to move. What's that?
And we've traded earnings.
Yeah.
We've seen volatility in the SPY as well, or in the indices, but we've noticed that it's dying down. What can we look for now? What are our new plays? Are we, with low volume, low volatility, it's probably not going to be great for selling options either. So
I know. That's what we talked about this week. It's like, I hate it. I hate that. So index wise, like, let's go to the SPY. So I was looking at that Tasty study, that I would love to take this trade. This is a 0 DTE trade in the SPX. Every single day you could collect $3 to $4 of credit and then manage that for a quick, $60 to $70 of profit. And if we have a low volatility environment, dude, you could take the trade by 9:30, and by 10:30, 11 o'clock, you're out with profit and you're done. Example would be, let's talk about this for today. So if I did this trade today, and I should have priced this thing and just had it hypothetical, but I was already live in my session. So we opened today. Excuse me. We opened today. This is a perfect example. We opened today at 541. Okay. So if I go to my option chain on the SPX and we do a 0 DTE. So here we open at 541. Is that right? Oh, I got to go. No. I got to go SPX. So let me get back to this chart here. SPX. I got to find out where that opened. There. So SPX opened at 5425, roughly. Open there. Okay. So let's see how much we collected. If we were at 5425, that's where we opened. So that would be 20 points up would be 45. I'd sell that call. And come on. Oh, I got to clear this out. 5445. And we opened at 25, so we go to 05. So that's my trade. Now, in a strangle, okay, an SPX strangle, you can see here you're still able, if you took the same trade with the same legs, you're at $6.40 credit right now. I've got to wonder if this was a trade this morning, what this initially traded for. So I'm gonna get a ballpark here, and if we're currently trading at 54.15, let's go 20 points up and 20 points down. So to 95 there. So if you're collecting, man, I don't know what it would have been an opening bell. I would imagine you're getting like $6 or $7 worth of credit. And right now you have the put side would have been tested a little bit. So 45 to 05. Your put side is being tested a little bit, but you're still okay. Your call side's probably mostly in profit. But I don't know what the opening bell trade was. So all I'm saying is, look, we're trading at a 13 IV rank. This week it was literally at like 4 and 5. It was a low volatility. It's jumped up a little bit, which helps the premiums. But what I'm getting at is, if there's an opportunity to take some daily trades or even go out a week, and take some of these trades where just go after these really tight take profits, that might be my plan. If I want some income, I might be looking to take some SPY trades or some SPX trades and just let the market be boring and try to squeeze out something. But to your point, selling options right now with a low IV, it kind of sucks. It's way better when IV is higher because you get way more premium up front. But if you got to settle for it, I mean, I looked at all the Tasty Live studies, and I mean, they go back 30 years, man. So we've had low IV, we've had high IV, and it's just you take the same trade. It's like whether it's low or high IV, it's like it's the same mechanical methodology, and you just take the trade. So
I'm looking at
I'm trying, dude. I want tons of trades, but I just got to think about everything, you know.
I've gone from, like the iron condors into credit spreads, and now I've just resorted to straight up calls and puts that I buy, like 1D DTE. So I can't really do day trades. I can do a few, but I'm limited. So I like going a day out at least.
Yeah.
And those they move very hard, very quickly. And so far they've worked out, but I've had a few where, if you're wrong, you're pretty much totally wrong because
Yep.
you don't have any time. But it's nice to have these quick moves, and then you can just get out, be done for the day. So I like that, but that does come with a certain amount of risk because you obviously right now, I was liking these plays below the highs, and now that we're at all-time highs or basically right there, it's hard to kind of tell, like, do you want to even have a call in play? Like, say you bought a SPY call at 541
Mm-hmm.
and it costs I don't know, $3 for
Right.
1 day out.
Yeah,
Do you
you need
think
it to
it's
break all-time highs.
Yeah, do you think it's gonna
Yeah.
break all-time highs by the next day? I mean, it
No.
could, but I don't know. The options or put options are a little cheaper, so the room to the downside just seems better. So it's something you just have to weigh. If the market pulls back, then maybe a call option will be good. But I was playing CPI. I was hoping that we get a lower number. Well, I was hoping we'd get a higher number, but then I flipped last minute, and
Well, it
just
worked out pretty well.
I bought calls at the end of the day, and it just outweighed my market value of puts, and so it
Uh-huh.
it ended up working out. But I thought, we're not at all-time highs. Maybe this will take us back up there, and then it did. And then now I kind of ran out of trades to make, so I'm kind of just sitting on the sidelines. But it,
Yeah. Well,
it's hard.
if think let's talk historical context of the market too. If you are reluctant to buy at highs, you're going to miss out on a lot of profit, because the one thing these markets do, and you can go back to you can go back for the last 20 to 30 years. I mean, 90s was a bullish market. We had a crash in 2000, 2001. We got through that. We had a pretty decent run to 2007, 2008. Post 2008, it's been one of the greatest bull markets we've ever seen since 2020. Like that's when it all corrected, was 2020. But you had like a 10, 11, 12 year, mostly uninterrupted outside of having some, some Fed backstopped, like 2018 end of the year sell off. 2019 was all up again. But my point is, there are times in these markets where all you get are higher highs. I mean, the last, let's go Q4 to Q1 of 2023 into 2024. All the market did was rip higher. Every single week for 16 out of 20 weeks was higher highs. So if you're not buying highs, if you're not positioning for higher highs, you're going to miss out on profits. If all you did in the stock market was, I need a dip, I need a dip, I need a dip, dude, you might not get it. So, I mean, I look at the performance of, have you ever seen a chart where it compares like the best days versus the worst days? And if you're not participating because of just, you want to time it so well, if you're not participating in all the best days or even the worst days and still buying in, it's like there's so much profit and movement that you miss out on.
Yeah, there's
That
no
it's
point in trying to, um, you know, get the short plays in when we're in an uptrend, and even if you're bearish, like I don't know if I'm necessarily bearish. I'm not bullish on the stock market, but it's in an uptrend and nothing is cracked. There's really no point in going against it unless you start seeing something where the floor gives out.
That's exactly
But
it. And that's
we're
this chart right
still,
here. That's this
yeah.
chart,
Look, the way
right? That's the
just
floor.
looking at the shape of this trend, why would you really go against it? I guess just
Yeah.
position
And so,
yourself for higher moves and yeah,
yeah.
just if
So
you're wrong, it's okay.
let's say there's a top, right? Let's say there's a top. This type of trajectory from this April decline to this May rip more than likely is not going to be faced with another April decline, right? There was a lot of, this was a lot of the confusion of, is it three rates? Is it three cuts to two cuts to one cuts? Is it zero cuts? That was all this drama. Plus inflation was ticking higher. Oil prices were going up. All these things were dampening the overall like inflation recovery. Once that was put to rest for a second, and then all of a sudden we had, a huge market rip on just overall earnings, biggest market cap stocks doing really, really well. Here we are. March is done. April's done. Like that correction's over. At this point, I see any correction being more of this rounded, right? And then all of a sudden it just kind of breaks and leaks. It's like if you're in a rocket ship and it's running out of gas, it's still going to drift with a low gravity orbit until it doesn't. And so rather than being bearish, like I said, protect your profits, play some defense. Look, you can start getting positioned into more defensive plays. I mean, I've got stocks that are value stocks. I've got stocks that are defensive. I've got sectors that are defensive. I've got stocks that are stocks in sectors that are uncorrelated. I'm in the VIX, so if there's a really aggressive push to the downside, I'm positioned for that. So I'm trying to play some speed chess with the market. But to me, this seems like a rounded out top is how this thing, just like it did here. This took its time to then finally cave and the floor broke. So until we break this trend line, I have a hard time really painting a bear case. So I'll continue to take my stabs. Like I look, my style a lot of times, Frank. Like I like these 1-2 week expirations. And if I was confident that there's like such a stronger move ahead, I would have positioned out to the end of the month instead of this week. But instead, it's like I'm going out to July, and I'm just like, you know what? If I can get a $10 to $11 move somewhere directionally for the next 30 to 45 to 60 days, I'm fine with that. And I'll pay for that, right? But right now it's like, I'm with you, man. I don't know if we're going to get a lot of additional direction because right now I feel like we're running out of catalysts. We've had the inflation news and, we had the Fed and we had our earnings in. So it's like now things have to start back over with, earnings kick off with financials and it's really boring typically. So you got banks, you got blue chips, and then you get into like the Mag 7 Fab 4, the big tech stocks, and then things get a little bit more interesting. But
Yeah.
it stretches like 4, 5, 6 weeks. So it's not going to be for a while. It's going to be starting in July.
So I think in this sort of market, yeah, you look for drifting higher, but also just look for new lows on the VIX because that has been a good
Yeah.
indication so far this year. In March, on the screen I'm sharing, we
Yep.
have the VIX hits new lows on March 28th, March 27th, and then March 28th it comes back up slightly. It's not really an indication of anything, but I think hitting these lows is that indication. So we have from March 21st to
Okay.
28th, we're basically at those lows. That's
There.
and from then on, we have March 28th and then all of April up until like late April, you have this downtrend. So I would say every time you see these dips to lower levels, look for potential plays to maybe pad your account just in
Yep.
case something bad happens. Don't leverage for the big short. Don't try to be the hero. But when you see the VIX hit these new lows, if this comes down under 1140, 1151, I guess,
Yep.
it comes down and makes another low. Maybe look to hedge a little bit to protect
Sure.
yourself. But I think that's the market we're going to be in. And I guess because we're in an election year, can't afford to see a crash.
It's true. And I think that's probably the best summary of this year. It's like how resilient and how Like how many blinders, or how strong are those blinders on the market to be like, we're just going to keep doing this. Nothing else matters. Let's keep doing this. That seems to be the play right now. But that also that does get me very, very defensive going into 2025. I think there's a lot of realities that a new administration or even a carryover administration has to worry about. It's been a really nice recovery, right? From a 2020, we bought our way out of it. 2022, we survived it on the backs of the biggest stocks in the world with a very hawkish Fed, with a crazy rate hike cycle. Effed up our bond market. It's market manipulation like crazy. But here we are at all-time highs once again, where it's just a weird thing to have markets at all-time highs, household equity at all-time highs. Consumers are probably a little bit strapped and spending on credit, but nobody feels good about this economy. That's what is that just me, or is that the consensus? Like, not a lot of people feel great about the economy and feel like there's so much crap, but it's also what you ingest. If you watch drama news and it's doom and gloom, that's gonna invade your thoughts. So I mean, I hate the news. I never watch the news. I read financial news because that's the data that I use to make decisions. But man,
Right.
I couldn't tell you the last time I care about anything that's not financial news related, because that's my wheelhouse. So
I think we're
anyway,
just gonna pay for it at some point, though.
we will, and we should. I mean, it's like you can't. I just how did 2000 happen? False valuations and crazy high valuations that are unicorns, right? How 2007-8 happened? Irresponsible over leveraging, and so many delinquent, non-qualified buyers out there. It's like that was a crazy Armageddon type risk in the financial markets, with like the entire housing market. You're betting against bonds. You're betting against the housing market. That's never happened. But here we are, 2020. I don't know what you call that. 2020 was ripe for a correction. They just put the bow tie on it, called it COVID. But it's not COVID that crashed the market. It was the abrupt reactionary decisions that all of a sudden, like, the whole world came to a halt. Everything stopped, everything closed. And then you're thinking, is the global economy now completely forever changed? But what do? We bought our way out of it. So, I mean, eventually, I think that's the problem that we're in, is we have boom and bust cycles that you can't avoid. That's going to be the scariest part, is we're going to have another crash. I mean, 2008 to 2020 was a long stretch, but I keep going back to this, and I think we talked a lot about it this week. That stupid inverted yield curve is it's going to come back and be the reality check that the market has been ignoring for a while. The deepest and longest historical inverted yield curve, at some point, is probably going to matter, and at some point the market's going to pay attention to it, and it's going to tie on and layer on all these Jenga pieces of, like, this is what's enough to finally get the market to tip over. And like we talked about, the scary thing would be, market starts to tip over, momentum starts to pick up to the downside, and the Fed steps in and starts cutting, and the market doesn't give a crap about it. Just keeps going down, down, down. That's the scary thing. That could be that 20, 30, 40% correction, and the Fed can do nothing about it. That's the scary thing to me. Does that mean that everything's ending? No, it just means that it's a cleanse, and hopefully you're not on the wrong side of that move. Hopefully you can hedge well enough, and you can walk away, profitable because of it, or you can just be unscathed. But if you're not protected, that's the worst scenario, is just like all-time highs and then watch a 30% cleanse do nothing but take away all your hard-earned investments. So you never want to see people in that position, but it's like, that's where at least having an understanding of what's going on here does make a big difference. That timing will certainly help you. Buffett says you can't time the market, just buy the SPY. But if you have a little bit of market timing to prevent 20, 30, 40% drawdowns, you're certainly a little bit better off than I'm up, my retirement account's up $1 million and now it's worth 600 grand because I was fully invested. That's where diversification can certainly help. You got to take away that correlation a little bit.
Yeah.
So
And it's funny how the dollar is up today and yields are dropping. As in, there's strength in the dollar, but the yields, I think that expectation of the rate cut, like you said, is still in play.
It is.
September rate cut. So would that not affect the dollar, though?
What rate cuts?
Wouldn't that make the dollar weaker?
It should. I mean, in
So
theory,
the
yes, it
dollar's
should.
coming up on the day.
But like
While
it's the last central bank to cut though. So I mean, right now in the forex land, I think the dollar is still going to be on the top of the mountain just because all of the central banks are starting to cave in and cut earlier. But like you said earlier, U.S. inflation is stickier than others, but the Fed's not cutting. You know, so I mean, yes, in theory it should short, but with other currency pairs that have all like leveled off and they started to cut rates, and not all others like the RBA's pausing, RBNZ pausing, Bank of England will find out next week. But with the Fed being like the last one to cut, then you wonder like, is it a race to the bottom for all these central banks? Not bottom being 0%, but is it a race back to like normal? Do we go from 5.5 down to 3.5? I mean, once the Fed starts cutting, that is ultimately going to be their plan. Is they're going to try to squeeze another 150 to 200 basis points over probably a 2 to 3 year window to cut rates, right? What they're trying to avoid is as they start a cut cycle quarter by quarter, that we don't see inflation stick its head up again and rear up. Like that's what's always happened. And I think that would be like this current Feds. This is kind of Powell's legacy, is making sure like you don't have a second wave of inflation where things get bad. So that's why this higher for longer, this restrictive, while the market's churning along, while the economy's doing just fine, while we're at all-time highs, it realistically, there's no reason to cut. But you have the people that are affected by higher prices, inflation, higher interest rates, mortgage rates. It does displace a lot of people. And I think again, I'm getting political here, but as a voter base, it's like you're kind of pandering to that. Like, look, we're trying to help the American people. We're trying to help the economy. Here's how we can do it. But a 25 basis points cut shouldn't really matter. But in this case, it does, because it's such a pivotal thing of once we start cutting, then the last thing you should do is right. Once we start cutting, we should keep cutting. But the issue with that is once they cut, I almost feel like this Fed is not going to cut quarter by quarter. Once they cut, they might wait 4 to 6 months before they cut again, right? Here, have your cut. But then they wait because it's data dependent and it's Jerome Powell saying the same thing over and over again. But I will say this, if people can look out a year or two from now and interest rates are finally, from 7% on a house to 6% or 5.5%, or let's say sub 5%. If we get there, Frank, in the next 2 to 3 years, that changes a lot of things for the better. But sitting at 7%, sitting at corporate interest rates at 8 to 10%, refinancing debt at 7, 8%, that is brutal. And it's not the environment that we've been in for 20 plus years. So that's like the big, ugly, snowball that's out there that can eventually become an avalanche. But we don't know how bad it's going to be. You're asking me this week about private credit, private loans. That's a huge industry right now because people are trying to service debt at more cost-effective prices. I mean, I bought a car at 6%, and if I went back, 6 months later, it's at 8%. My house is at 2.8% versus, I mean, I couldn't imagine going to talk about a house right now at 6.5%, 7%. I'd be like, it's not a house I want to buy. That's unaffordable. I'm not going to take those mortgage rates. So anyway, that's like, again, that's probably out there, and that's the big snowball that's probably gathering some steam and momentum, but it's not ready to crumble yet. It's not ready to topple over and start pushing downhill.
So my concern about private credit though was, I mean, they say that they try to get the best of the best, and they want people with companies rather with just really good credibility, like people that are going to pay off whatever their loans and match what they need to do each payment period. But what I saw, and I mean, I can't tell if this is true or not because it's just like one person saying this, it was that they were I guess like the growing number of defaults is getting bigger, and I don't know if that's true or not. I want to do my own research. I'm trying to look up where I can look at that kind of stuff. But I'm wondering, with higher interest rates for longer, people are going to be spending less, and they're going to probably want to not take out as many loans. They don't want to go to companies to raise money for them because they're not really looking to expand right now. They're
For sure
saving their money. So these private credit companies, I'm wondering, their audience, the best of the best of people that are going to pay off their loans, are not really involved right now. So what are these companies going to do? Are they going to look to lower, on the totem pole, like people that are a little more riskier, or where
a good point.
these tranches get riskier and riskier, and you get like triple Bs instead of triple A's, and now
Right.
you're just on you're on people that you're loaning money to, but they're not gonna be able to pay back, and then over time you're just giving out loans to just all your new crowd is people that can't pay, is what I'm worried for.
Yeah, and I mean the new crowd could also be a buy now pay later. It could be essentially like a giant layaway crowd. So maybe it's bite size. Maybe there's structure to repay. Maybe there's payment plans and things like that. I mean, I think that this sounds very ominous and this sounds very much like 2007, 2008. But a consumer bubble is probably a lot different than a housing bubble. So, I mean, we have heard for the last 5 years, student loans are going to be in a bubble. It's over, $1, 2, 3 trillion of student loans. Debt, consumer debt, credit card debt. It's blah 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 in billions or trillions of dollars. I mean, it's that. Look, the housing market, household wealth is like $160 trillion. That's why 2007 and 8 was so catastrophic. So a new bubble sure can matter, and it's going to hurt the consumer and it's going to be painful, but I still think that the sad reality is it's affecting a certain like socioeconomic class, where it's like if you don't if you are in a position to be taking out loans and leveraging debt, that's a very different person than just somebody that's trying to scrape by and get by. And having wage growth or having no wage growth or having 2-3 gigs as opposed to a full-time job with benefits. So anyway, I mean, I just think it's stuff we have to watch, man. I mean, I say this for a lot, or I say this all the time. Technically is what I focus on. Fundamentally, it's my awareness. I saw Nick posted this online. He's like, being a top fundamental analysis trader. I mean, it goes back and forth. I mean, I've taken a lot of trades over my career where it's all on the chart, and then the fuel and the driving force behind it is the news, lines up with the technicals, and those are usually your best trades. So I think they work hand in hand. I don't think you can be exclusive technical or exclusive fundamental. I think you have to be aware, and so we're talking about all these things that we'll be aware of, but whether they matter today or next month or the next quarter or the next 6 months or 12 months, I don't know. And
Well, they
I'm
obviously
no
don't
better
matter.
forecasting than anybody else.
The technicals don't matter sometimes, and fundamentals don't matter sometimes. I feel
Yep.
like you're right. They have to go together. Just look at the SPY.
Yeah.
Technicals say it should come down. It's been saying that for months, but
Yep.
it's not. So yeah, they don't always work independently. You kind of want them. You want to match them, and that's when those
If you
trades
blend
work.
it. I think if you blend it, it's helpful. Just and again, technically obedient, fundamentally aware. That's kind of my mantra. So, hey, dude, I got to run. I got to jump into another trading room. And thanks for jumping on today. It's been awesome to be here all week with you guys. And I'm not sure if you guys are still running your 25% off Edge Finder, but I would say for anyone watching, jump in, grab your Edge Finder, open up an account with 8cap, work with A1 Trading with all the promos you guys offer, and get a great piece of software. And all these decisions and conversations you can have at your fingertips by looking at the Edge Finder and following sentiment, following smart money, seeing where things are positioned. The COT reports are great. I'm watching the inverted yield curve. Honestly, Frank, that's probably my favorite thing this week that we talked about was just looking out for the next 3, 4, 5 months, that October 2024. I want to do this. I'm gonna go back and try to find the averages of inversion to recession. And I know the average is 24 months, but I want to find how long we've actually stretched, because I know in some cases we've stretched like almost 3 to 4 years before we had a recession. So possibly with that inversion, we might stretch another 12 months. So
Right.
going in, but I think October at 24 months, stretching into maybe Q1 of next year, Q2 of next year, that stretches that 30-month period, man. It's like, I'd be ready for a correction, right?
Yeah.
Yeah.
I agree.
So,
I could see it
cool.
happening, but we'll never know.
Well, will it happen? You never know. You never know until it's going to be here in front of us, and we're talking about it live. So that's when you'll find out. It's when it's all happening. But that's why you trade, you stay diverse, you trade uncorrelated, you just follow strategies, and most importantly, is risk. Risk management is the key to being a good trader. You got to manage your risk, because Frank, I'll if you don't mind me being transparent for you, look, dude, you had a great week, but you kind of took a crazy trade.
Yeah.
Yes.
No, I know.
Yeah. So it's like, dude, I'm happy that it worked out, but it's like, that's a risky way to trade moving forward. And I think you know that. So it's great when it works out, but you also, if it doesn't, you're like, why did I do that? So I've had a lot of those. Why'd you do that? And so I've corrected my bad actions from the past. And I've had enough experience where I just don't want the trades to really have to affect me that much. I don't need to hope, like that's not a strategy. So again, just keep trading, keep focusing, have some fun, have a great weekend. I don't know what you're doing this weekend, Frank, but enjoy it, man. Have a great weekend.
Dude, thank you. You too. And
All
thank
right.
you for the advice. You're right. It was a risky trade, but
I know. But hey, dude, it paid out, so it's cool. Hey, if you want to get online later today, let me know. I'm gonna jump in this trading room and I'll be good in the next hour.
oh yeah, for sure.
Okay.
I'll let you
All right,
know.
everybody, thanks for being here this week. Happy trading, lots of profits. Happy Friday. Have a good weekend. We'll see you next week. Thanks. Bye.
Thank you guys.